Hello folks, my name is Brett Pattison. I'd like to welcome you to the recorded version of Looking Back to Look Forward, Finding an Edge with ETFs that was presented in Orlando for the InvestTools Investor Conference. We're going to run through the exact same presentation that I did present live in Orlando and look forward to doing that. But before we jump into the content and look back to look forward, let's run through some disclosures so understand this, which we talk about today is for educational purposes. We're not financial advisors or a broker-dealer. Investing involves risk. Understand those risks before you invest. And, of course, there's the options disclosure as well. And then we will be mentioning a lot and discussing a lot in the world of ETFs. So there's some ETF disclosure. Know what you're buying, essentially, is what that disclosure is saying. All right, so there's a picture of me and a little bit of my bio. I've worked with InvestTools, now TD Ameritrade, for the better part of almost 10 years, and have been teaching live workshops to not only retail investors but also those that manage money, and that's the registered investment advisors. For the past 2 or 3 years, I've also guided some of the content decisions that are made at TD Ameritrade and InvestTools. And I love what I do, and I hope what is taught today will benefit you and your portfolio, not just, for the hour plus that we're together, but also hopefully for the next months, years, decades. I'm confident this content is such that it can do that. So the one thing that I want to bring up front, especially those that maybe have a background in trading, okay? And especially with InvestTools, those that have been with InvestTools, I want you to, in this session, certainly, I want you to think differently. So what you see here in front of you is a picture of an individual by the name of Abraham Wald. Abraham Wald, back in World War II, was in England, and the British Air Ministry was encountering a problem, and the problem was that their planes kept getting shot down by some Germans. The Germans kept destroying the British Air Force, and the British Air Force thought, crap, we got to do something, or we're going to lose this war because we're not going to have an Air Force. And so they found Abraham Wald. Abraham Wald was a statistician. That's what he's known for. He is a mathematician, statistician. They approached him, and they said, Abraham, we need your help. Our planes are coming back looking like this. They have holes in them everywhere, and what we need to know so that we can solidify our Air Force and try to win this war is we need to know what part of the plane should we reinforce. What part of the plane should we add some additional protection so that we stop getting shot down? And Abraham looked at that, and he started running some math behind it, statistics. Let's analyze all the planes that are coming in and where the bullet holes are and everything else. I want you to take a look at that picture and imagine yourself in Abraham Wald's shoes. You're saying, okay, what would I reinforce? And I want you to think at home or wherever you're at, where would you reinforce on that plane? What part of the plane would you reinforce? Okay? Take a moment to do that while I complete the story of Abraham Wald, because he encountered that same situation, and he said, you know what? I want to reinforce everywhere there is not a hole in that plane. That's what he said. I want to reinforce everywhere there's not a hole in that plane. Now think about that for a second. He's thinking differently. It's like, okay, there's a lot of holes in that wing. Why don't we reinforce that wing or that the tail of the plane or wherever it may be? What he's saying, let's reinforce everywhere there's not a hole. And if you think about that, it's completely thinking outside the box. It's thinking differently, but it's so simple once you understand what he and why he said that. He said, let's reinforce everywhere there's not a hole because all the other planes that are not coming back, they've got to be getting shot where these planes are not getting shot. And that was his reasoning. these planes are coming back. The other ones aren't. Let's reinforce where obviously those other ones are getting shot down. And so that's what he did, and that's what the British Air Ministry did. That's thinking differently. That's taking a scenario that you have in front of you and completely thinking outside the box, which is what we're going to do today together. We're going to think a little differently, and I'm going to say we're going to think a lot more simple, if you want to phrase it that way. We're going to simplify our thinking and think outside the box, and you'll be amazed at what we can accomplish when we combine those two things. And so today's goals in the next hour that you listen, is to do this. We want to learn a couple things. We want to learn, quickly what a model equity portfolio looks like, because that's where we're going to spend our time today is modeling an equity portfolio. So I'm going to show you what a typical, say, I don't know, mutual fund manager or portfolio manager or money manager, how they create their portfolios. And then we're going to build 3 portfolios together. The first one is a passive portfolio. The second thing we're going to do before we build another portfolio is once we build the passive portfolio, we're then going to take a look back so that we can look forward. And that is we're going to review the market history to try to find an investing edge. So we'll look at historical returns and what that means and what does it mean going forward. And then we're going to build our second portfolio, which is an active portfolio. After we build our active portfolio, we're going to build something that is very technical in its, in what we call it. We're going to build a super active portfolio. And then we're going to round it out after that by talking about portfolio management and additional ways to consider your portfolio management. By the end of today, by the end of the next hour, my goal for you is to become a portfolio manager, become your own. And I'm going to speak to that more in just a moment. But first, just so that we're on the same page, all of us together, we're going to use the bulk of our time today. It's going to be with ETFs. So let's understand what an ETF. An ETF is a basket of stocks that tracks a mutual, assets that they're, let me start over there. It's a basket of stocks that track assets like a mutual or index fund. So something that tracks the S&P 500, for example. It's also, an ETF trades like a stock throughout the day. So you can buy it, you can sell it throughout the day, you can put a stop loss on it, all these different things like that. And typically, not all the time, there's some great mutual funds out there that are cheaply managed with their maintenance fees, but typically, ETFs will have lower maintenance fees than mutual funds. So understand what an ETF is as we are going to dive into it head first here in a moment. Okay, but let's start on that first goal for today, which is understanding really what a model portfolio is and how we're going to build it, or how professional money managers, if we want to call them that, how they build it. Okay, so here's a model portfolio that you see in front of you. You've got U.S. stocks, 35% of that portfolio is U.S. stocks. It could be large cap, small cap, medium cap, U.S. stocks. You've got 25% of international stocks. And in that international slice, so 25%, in that international slice, you're going to have 2 different components. You're going to have countries that are considered developed. Okay, and make sure you have a piece of paper at home and you're writing notes, but you're going to have countries that are called developed, like Europe, for example, Japan. And when we say developed, those are the countries that have an exchange in place. They've got security in place that have been in place for a while now. Their infrastructure is such that there's not great risk to it. That's developed, markets. The other slice of the pie with that international portion is what we would call emerging markets. Emerging markets are like your China, your India, your Brazil, your South Korea, markets that are maturing but not, on the maturity level as that of, developed markets. Okay, so that's that international component. Bonds, of course, fixed income products, and then the alternative part, which is 15%. And so what we're going to do is we're going to focus mainly on the equity portion, which is the 35 and the 25. So that 60% portion is what we're going to focus on today. Okay? But I even want to take a step back because I want you to understand what we're doing and the importance of it. And those of you at home that have been trading options and futures and forex and and trying bull flags and bear flags and all this other stuff, I'm guessing 90% of you, that's what you've been focusing on. Are those strategies that are more active in nature, that may be a little bit more complex, certainly are, take time to master. Well, the portion of the portfolio that you've been spending all of your time on has been right here, that alternative investments. That's a terrible color to use, yellow. Let me circle red. That's what you've been spending the bulk of your time on, 15% of the portfolio. So while you've been spending 15% of, or 90% of your time on 15% of your portfolio, you've had 60%, 85 if you want to include bonds, that you have not been spending time with. Well, today that changes. So I would encourage you to do one of two things as we talk today. Okay? Number one, and that is number one, which I hope is what you select and choose, and that is, hey, I'm going to manage that 60%, which is these two. I'm going to manage these two by myself. Okay? Using what we talk about today. The other part of that is if you don't want to manage the 60%, if you just want to say, you know what, I just want to focus here because that's my love, I love trading Forex or whatever it may be, then you need to find somebody to do the rest. Find somebody else to do it. And that's an important part of our discussion today. And that's not the last time I'll say that. We'll talk about it a little bit later. But let's move on and talk about how we build the 60%, or not really how we build it, but how a call it professional money manager would build it. And it all is geared around top-down analysis. So the first part of top-down analysis is looking at the global markets. What's the U.S. doing? What's Asia doing? What's Europe doing? What's China doing? Those are global markets. Then as we move down the pyramid or the cone, I guess, the funnel, the next component would be countries and sectors. Okay, that's top-down analysis. After that, we've got stocks. All right, so a portfolio manager would actually do all three, and they do all three. And let me explain what I mean. We're not going to, but a professional money manager does. Now, who's right and who's wrong? I don't know. We can argue that, but I'd say from a simplicity standpoint, you'll answer that question for yourself here in just a moment. So if we look at this U.S. market, we're going to focus on the S&P 500, which is large cap. We're going to say 35% of our U.S. stock-based portion of the portfolio is in S&P 500, and it's in these different sectors. And it's allocated these different ways: 18% in information technology, 12% discretionary, 3% telecom. You get the point. That's how it's broken out by sector. So you have this 35%, which if you were to slice up the 35%, which would be sliced into these percentages. Okay. Now beyond that, you then say, okay, here's the stocks that make up information technology. We've got Apple, we've got Microsoft, we've got IBM, we've got Google. Those make up that 18%, which makes up the information technology, which helps make up that U.S. stocks 35% portion. Okay? And you go all the way down, and so you're buying all these stocks at different allocations to create that portion of the 35% portfolio. And then you've got this portion. You've got the international stocks portion, which is developed. We talked about that. Developed non-U.S., which is, in this example, about 17%. And emerging markets, which is 8%. You do the same thing for developed non-U.S., which is that 17%. And you say, okay, well, how's that allocated? It's allocated like this. We're going to own all these different countries, and then we're going to own all these different stocks in these different countries. Okay, no big deal. And then you're going to say, and here's my emerging markets portion of the portfolio. and there's how it's allocated between these different countries, and here's the stocks. So at the end of the day, you've got all these stocks in all these different countries, and you're saying to yourself, okay, I did it. Now you got to manage it. Yeah, good luck with that, right? It gets hard. And there's nothing wrong with the approach, especially for those that love stock analysis and think they can pick the best stocks. But I want to simplify this. If you're thinking to yourself, holy cow, there's no way I can be a professional money manager the way they do it, I would say, no, you're wrong, because we're going to simplify that in a big, big way, looking at ETFs, all right, and utilizing it. We're going to accomplish the same thing using ETFs today. That's the 60%, right? So let's move forward now that we understand what a model equity portfolio looks like. And we're going to come back to that. And I'm going to show you really just how simple it is to do what we've just done. And we're going to do that by building a passive portfolio. So as I think of this question, what does it mean to be passive? You know, and think of at home as you're sitting there, think of what it means to you to be passive. And I would say this, it reminds me of a goldfish. In fact, it reminds me of my fish, my beta fish. It wasn't mine. Actually, I've got 4 beautiful children. Little Ella K, she's 3 years old. She has a fish we call Muka Puka, the beta. Well, to give you an idea of what kind of passive portfolio we're going to build, I'll tell a story about Ella. Ella is, 3 years old, this cute little blonde. She's got these little pigtails coming out, and she has fed her fish, I think, once in the past 6 months. And she walked into the room where the fish bowl is, and she just dumped it in. And then she walked away. And the fish just lives in this murky water, and it just lives. It's an amazing scene. It's alive, but it's so passive in its approach. It's like buying a fish and feeding it once a year, right? And then that fish sustains itself. That's what it means to be passive. So there's 4 steps to that, okay? And if you at home have a PDF version of the reference guide that we used in the conference, we're going to be on page 5. The pages are in the lower right-hand corner. If you don't have a PDF version of the reference guide, just pause the recording and take some notes. But those are your 4 steps: to select your allocation, select your ETFs, invest in your portfolio, and manage your portfolio. And we're going to hit all 4 of those many times today, so they will be ingrained in your memory. So the first thing we need to do, step 1, is we need to allocate and select an allocation that works for us. That's the first thing. And we'll use just this model portfolio that you see in front of you. It's kind of aggressive according to most CFPs. But it's 60% equities. Okay? So that's the select your allocation. I don't think it's too aggressive, by the way. But that's your allocation. So let's move to step 2. Once we identify that, and everybody's going to be different based upon your age, your circumstances, how much money you have, then we move into the next component, which is select your ETFs. Now at this point, I need to make a transition in this WebEx that I'm using, because I need to share with you my desktop. And I'm going to share with you this monitor here. Let's make sure it's working. Okay, beautiful. And I'm going to bring up, let me take some of the stuff down, apologize for that. And I need to bring up, oops, I've got all sorts of things open, don't I? Let me close that, and I'm going to bring up the PDF that I referenced earlier. Okay, so here's the criteria for selecting your ETFs. This is in your reference guide. The number 1 thing is we want to look at low expense ratios. Low expense ratio, and you don't need to read all this, but a low expense ratio is just how much it costs to own the ETF and to pay those that are managing the ETF. Optionable is the second thing. Now, when I say optionable, that's for those that want to sell covered calls. Now, think about that. If you don't want to sell covered calls, then your loan focus would be low expense ratio. Select those with the lowest. Optionable, if you want to look at options, then you would want liquid options, not just options, but liquid options. Okay, so let me scroll down and I'll show you several ETFs. Okay, I'm going to blow this up so you can maybe even see it a little bit better. We have three components. We have the United States, we have developed non-U.S., and then this should not say financials, it should say emerging markets, not financials. So if we look at this, United States of America, I can see that the expense ratio column, here's my ticker symbols, here's my expense ratio, here's whether they're optionable, here's whether they're liquid options. So it becomes pretty easy for me if I want to trade those products that are liquid, that have liquid options, right? And I would go to the SPY and I would say, okay, there's my liquid options. Let me change the color on this to black. There's my liquid options. Here's my liquid options. Here's my liquid options. And so that would be the tickers that I would look to use if I want to trade options. If your loan focus is expense ratio, then this is the lowest, so this would be the product for you. This is the lowest, so this would. This would be the lowest, so this would. Now, of course, you need to look at the ETF and identify a little bit more and figure out what's best for you in your situation and make sure you're comfortable with what the ETF owns. But by and large, what we're going to use today are these three because I love to sell covered calls. I love the premium of covered calls, so I like to sell them. Whether you know what a covered call is doesn't matter. We'll use these three ETFs in our example today. Okay? So that's the component of selecting an ETF. So let me do this. Let me stop annotating here, and I'll share this PowerPoint, and we'll work off of just my desktop from here on out. So we've got these ETFs. We're going to use the SPY, which is the spider, which tracks the United States. We're going to use developed non-U.S., which is called EFA, which is Europe, Asia, Australia. When I talk about Asia, I'm talking, mostly Japan. We're going to use the EM, which is emerging markets, China, Brazil, your BRIC countries, BRIC a term, Brazil, Russia, India, China. And then if you want one ETF that tracks the entire world, you run through the same three steps, and you could use what's called the ACWI or the ACWI, which tracks the entire world. All right, so that's step 2. We've selected our ETFs. Okay, step 3 is pretty simple. You're going to see just how simple it is. Now we need to buy stuff. We need to invest in the portfolio. And so far, portfolio is and let's take this a little at a time. And in fact, what I'm going to do, I'm going to bring up a Word doc. So let's bring that Word doc up, and it's the same exact thing that you see in the reference guide. We've got $60,000. Let me blow this up a little bit better so you can see it more clearly. We have $60,000, which represents 60% of a $100,000 account. So if I have a $100,000 portfolio, 60,000 of that, or 60%, is going to be in equities. Here's the ETFs that I selected, SPY, EFA, or EFA, and the EEM. And here's the allocation percentages that I mentioned earlier. We've got 35% in the SPY, 17% in developed non-U.S., 8% in emerging markets. And then it's just figuring out, okay, here's my dollar amount. Here's how much I'm going to invest in the spider, the U.S., developed non-U.S., and emerging markets. And this current price, and I filled this out for you, the current price of the SPY right now, and I just picked a number, so I didn't have to do a whole lot of math. It's actually trading lower than this now at 167, but we're going to use 170 as the example. Okay, so all I need to do is bring up a calculator. Let me grab my calculator. I'll grab it from our trading platform, Thinkorswim, and I'm going to grab the calculator, and we'll pull that out, and we'll do some simple math, and you'll see just how easy it is to own a fish-like portfolio. So then I go 35,000 Right there, that's 350. 35, 1, 2, 3, divided by the price of the underlying. And I need to move this so you can see the formula. Here's the formula. How many number of shares do I buy? Dollar amount divided by current price. So 35,000 divided by, 35. Try that again, apologize. Divided by 1, give you 205 shares. So how many shares would you buy? You'd buy 205. And you do the same thing for this. EFA, you say, okay, let me see here. I have $17,000 I'm going to allocate to developed non-US divided by 64 equals 265. And I'm going to buy 265 shares of that. And then you do the same thing with the EM, and I promise we won't do a ton more math, but this is how you would do it. And then you go 8,000 divided by 42 equals 190. Boom. And then you go into your brokerage, and it's very simple. Let me see if it's in this paper money. I think I've got the right one. You buy just like we did here, okay? And you allocate 190 or whatever the number was, 190 here, 265 here, and 205 shares to the SPY. And that's it. And that's it. Now, what do you own is the question. What did I just do? Well, before I show you what you've done, let me tell you what your objective is in what you've just done. You have employed a strategy by buying those 3 ETFs. You've employed a strategy that will help you closely match the market. If the market's up 10%, you're going to be up 10%, maybe up 9%, maybe up 11%, depending upon how those countries do. So your objective in this type of portfolio is to match the market, which is pretty good if you could do it. Let's be honest. A lot of portfolio managers can't do that. So you're matching the market. So what do you own, right? What is it that you own? Let me show you what you own. You own or have exposure to all of these companies. Just look at them as they flash on the screen. Approximately 2,300 different holdings, different companies in many countries, dozens and dozens of countries, and dozens of countries. That's what you own. That's a diversified equity portfolio simply by buying those 3 ETFs. In the world of Walt Disney, or I don't know if it was Mickey or Minnie or who, you've got the whole wide world in the palm of your hand. By doing that, passive people, if what you're trying to do is very simple management or a simple approach, you want to be a fish-style portfolio manager so you can go focus your time on that 15%, that's what you've done. Now, how do you manage it? You check it annually at the end of 1 year, whatever that 1 year mark is in your calendar, January 1st or December 31st or March 1st, whatever that year is, you would rebalance it. So what I mean by rebalance is if you start with 35% in the U.S. and all of a sudden you own 40% because of capital appreciation, then you need to sell and rebalance back into that 35%. So I'd sell 5% if I now have 40 at the end of the year, go back into my 35% in U.S. and you just rebalance it in that fashion. Okay? Very simple in its management approach. You do that once a year. Passive people, we're done. That's a passive portfolio. That's it. Okay? So you're good to go. Now, I want you passive people to just go relax on the beach now, hang out, enjoy life, whatever, whatever exotic place you want to think of, okay? That's our first portfolio as passive investors. So passive investors, you're done. Fish investors, you're done. Don't go anywhere because I think you're going to like what we're going to share in a minute, but that's how you manage that portion of the portfolio, okay? So let's do these 2 things now. Let's review market history. Let's put the passive portfolio on the shelf for now. Now let's review market history to try to find an investing edge, and then we will also build an active portfolio as we do that. So let's look at history for a moment. Let's look back so we can look forward. And I've got a great picture here of lightning. So the question I would ask you is this: why in a lightning storm don't you find a tree? Why in a lightning storm don't you go and crawl under a tree? And you're all probably thinking the same thing right now, and that is because you're going to die, right? Because the lightning's going to strike the tree, and you're going to die. Well, why? Because history has proven that to us. History has proven that lightning strikes those tall objects during a storm, and so you don't do it. So I would say it's the same thing with market history. You're not going to die, but it's the same principle holds true. Okay, let me show you some statistics, and even before the statistics, here's one of my favorite quotes from a Charlie Munger, who is Warren Buffett's partner at Berkshire. An incredible investor. He said this. He said, "I believe in the discipline of mastering the best that other people have figured out." Mastering the best that other people have figured out. And I like this second part. He says, "I don't believe in just sitting down and trying to dream it up all yourself. Nobody's that smart." I love that because at one point I did try to dream it up myself, and I was not a profitable trader, no question. Okay, it's when you look at the history and look at what other people have done, and then apply it. That's where the strength is. So what I'm sharing with you today is nothing new. I didn't invent it. Okay, other people have, and I love that quote. So here's some historical information for you. Here's the chart of the S&P 500 from 1929 to 2013. You can see that it's going from lower left to upper right, and certainly has had some volatility. Volatility defined by those peak to troughs, we'll call them. Okay, so here's some historical information that may help you psychologically in the market, which is important for you as you become a portfolio manager. And that is this: bear markets typically last about 21 months in duration. Bull markets typically last 57 months. We tend to think the exact opposite because those 21 months, they hurt bad. Those 57 months, it seems like we're always saying to ourselves, when's the bear market coming? Right? Rather than looking at it and say, oh, this bull market's only existed for 30 months, we're about halfway that done. And so it's these types of historical numbers that I'll be sharing with you, and hopefully they help from a psychological perspective. Cumulative returns for bull and bear markets, minus 40% on a bear market, plus 164% on bull markets. Cumulative returns since 1929, huge difference. Okay, let's take a look back at a period of time that we're all familiar with, and that's back to 2009. And here's the crash. The crash, the debacle, the banking crisis. Think of one word and write it down on a piece of paper of what you were thinking back in January, February of 2009. Because at that moment in time, something happened, okay? And the market rebounded in March of 2009. And it was insane. It was so insane that the business headlines, and these are actual headlines, said, the stock market's soaring. It's gone too far, too fast. And many people bought into that notion. They said, yeah, it has. I need to sell. Okay, well, what happened after that? Boom! The market rallied even more. And the headlines came out and said, despite celebrations on Wall Street, analysts say rally may have gone too far, too fast. And you buy into the headlines. And so you don't get in the market, you stay in cash, or you keep selling. Well, if you truly understand from a historical perspective, the history of the market, you'll understand that that's not the case. Okay? So if you truly understand from a historical perspective the history of the bulls and bears, you would not have gotten into that trap that the press was setting for you, and that is this. The historical history tells us the first 3 months of a market rebound. Okay, so after a bear market defined by a 20% pullback, in the first 3 months, you're going to see on average about a 23% increase in whatever that pullback was. It's making a quarter, it's making up 23% of that downward move. The first 12 months, it's making up 46%. So half of the bear market is recovered in the first 12 months. Well, if you're sitting there and you're freaking out and you don't know history, then you're saying, I'm not getting in this market. This market it sucks. I'm not getting in it. CNBC saying this and Bloomberg saying that and Barron's, it's a bear trap and all this other stuff. No, they're wrong, because history tells us so. And that's a theme I want you to ingrain in your mind, because history tells you so. Okay, so from an active portfolio approach, what does being active mean? Well, it reminds me of this little guy. Okay, it's a little bit more work than a fish. Okay, not a ton, because this is a little guy that doesn't cause, look at those eyes. Come on, he doesn't cause too much trouble, right? So what does it mean to be active? Well, we're going to take the same 4 steps that we just used, and we're going to select an allocation, we're going to select ETFs, and we're going to do a little bit differently in step 3 than we did in the passive portfolio. And that means we're going to overweight what's in favor, we're going to underweight what's out of favor, and we're going to equal weight what remains steady. And then at the end, we're going to manage our portfolio. Okay? And it's not going to be, you're going to be probably amazed at the simplicity of it. So the first thing, select your allocation. We've already done that. Boom, done. Okay? And the next thing is select your ETFs. We've already done that as well. We'll use the same ETFs from a simplicity standpoint. So that leads us to this step 3. Step 3. All right, let's go through it, and I'll show you what it means. And again, we're going to bring up the stock market history. This is from the Trader's Almanac, their numbers, and you can go and you can crunch them yourself. I have done that. In any historical numbers that I bring up, I would urge everybody to not take my word for it, not take the Trader's Almanac word for it, but look at the numbers yourself and see if this stuff really is what we say it is. And that is this. Since 1950, the Dow Jones Industrial has done the following. And these are 2 different time frames of the year. This is May through October and November through April. So we're slicing the year in half and saying if you would have only invested in May through October, you would have this after, since 1950. Your average gain was minus 0.4%, and then you invest that, you've got less. You've got less money because the market was down, and you were never able to make up for your losses. So what does that tell you? At home, in fact, pause the recording and write down what you notice about May through October, because November through April is a whole lot different. And November through April, if you're investing in those months, your average gain is 7.5%, and your return is dramatically better. Dramatically doesn't even do it justice. You're 609,000 cumulatively, cumulative return. So you're looking at that and you're saying, okay, well, May through October really sucks, and November through April is really good. And that's it. Now you're starting to see the history of the market. So what can you do with that, right? What can you do with that? Well, these numbers are just the Dow Jones, which is U.S. market, okay, and not even the entire U.S. market. And so what I did is a friend at S&P Capital IQ ran some numbers for me, and he produced these, and we were exchanging emails, and I asked him a question, and so he put it together. He's the smartest guy I know, and anything he publishes you should read, and his name's Sam Stovall. But he sent me these numbers, and we have his permission to use them. But this is the international markets. We've got the S&P 500, which is your U.S. market. Same time frame as far as months go, November through April. The market, U.S. market, averages a 6.9% return. In May through October, 1.5% return. So very similar to the slide before. The MSCI EFA is what that's called. Don't let that throw you. That's the ticker symbol EFA. That's your developed non-U.S. November through April, numbers return 4.9% and down in May through October. MSCI EM, that's your emerging markets. That's the ticker symbol EEM. 12% return November through April, 0.9% return May through October. The same principle holds true in the international markets as it does the U.S. And so look at these returns here, and you'll start to notice something. Okay, and that's those big black boxes are around the best returns for that time frame. And so what do you do that's a little bit differently in the active versus the passive? Well, that is you overweight and you underweight. So here's a consideration for you. November through April, you overweight the United States in the emerging markets. Why? Because they have the best returns. And in May through October, you flatten everything and you go to equal weight because they're pretty darn close. Okay, they're pretty darn close. So equal weight everything May through October and overweight the S&P in the emerging markets. And keep in mind this, if you overweight two things, you've got to underweight something, and so you underweight the thing that performs the least, and that is your developed non-U.S., Asia, Europe, those countries. Okay, and that's it. That's your active portfolio. Now, how do we do it? Well, that brings up this little table that you see in front of you. I'm going to go to back to that Word doc. And I've done some math for us. Let me explain this math. And again, you can pause the recording and write this down. But what we've done here is here's our normal allocation. It's 35% U.S., 17% developed non-U.S., 8% emerging markets. Your regular portfolio amount. That's just what we did on the other paper or in the passive portfolio. Well, now what I want to do is I want to overweight this by 3%. And in the workbook that we provide to people, it says plus or minus 10%, 10% on the high side. We're simplifying it, or we're not being too aggressive. We're being a little bit conservative. We're saying 3%. Want to up the ante on the U.S. side by 3% and 1% on emerging markets. And then we're going to, if we're going to up this 3% and 1%, we've got to decrease this 4%. Okay, so that's how those numbers shake out, or percentages. And so what we need to do is say, okay, well, what's 3% of 35,000? Okay, well, it's $1,800. What's 4%? 2,400, and 1%, 600. Okay, that's how you would approach it. All right, and it's actually, it's actually of the 60,000, not the other way around. So 3% of 60,000, 1,800, 2,400, 4%, and 1% is 600. Okay? Of the 60,000, not these numbers, but it's this number, 60,000. All right, so what's our new amount? We're going to add 1,800, which again is 3% of 60,000. We're going to add 1,800. So now we have 36,800 to the SPY. We've now changed this. We're going to deduct 2,400 here. Now we have 14,600, and we're going to add 600 here. So now we have 8,600. And you can see how these numbers are different than the regular portfolio amount that we just crunched in the passive. And you run through the same thing, through the same formula, and you figure out how many shares you have now. All right, and it's going to be different than the passive portfolio because you're buying more shares. That's all you're going to do. And that's only during those times of the month, November through April. And then when May approaches, you're going to flatten it all out. You're going to say, okay, I'm back to my regular portfolio amount. So really you're making 2 trades, or really 6 trades, 3 products twice a year. You're making 6 trades a year. And why are you doing that? Because history has proven that this one 6-month time frame in the market outperforms another. And that's why you're doing it. And you run through the simple math. Okay? All right, history tells us so. That's the answer. And then the step 4 is just to manage your portfolio, checking it semi-annually and making those adjustments. All right, that is, my friends, an active portfolio. Active portfolio, you're on the mountain, you're the king of the world. You're king of the world, all right, or king of the mountain, whatever it is. All right, so let's build this last portfolio, which is the super active portfolio. And you're going to see just how super active it is. I got a picture for you that identifies being super active. The pack of dogs. And I want you to answer this question. This is a very important question. And that is, which dog do you think is the biggest troublemaker of that group? And I'm looking at that terrier on the far right. So, anyway, it's like managing a pack of dogs now. You're going to add a little bit more to it. And it's the same process as the active portfolio, and I'll tell you why it's super active here in a moment. And really, it's what makes it a little bit more active than the active portfolio. What makes it super active is our top-down approach. We're going to add one thing to it. We're going to add sectors to the equation. That's what we're going to add to it. So we've talked about global markets the entire time. Now we're going to add sectors. Not getting to countries in this webcast, but we're going to talk about sectors. And then, of course, you have the stocks component, which we're not even going to touch. And I'll tell you why we're not going to touch it. Because every layer of top-down analysis adds complexity. It adds risk. And it, on the flip side, it adds reward. So it's more complex, it adds more risk, but it also adds more reward. If you want to go to the stock side, you find good stocks that are fundamentally sound, that are trading at a good value, and you pick up a couple a year, and that fits into your portfolio allocation. But we won't go down that road today. All right, so step 1, select an allocation, done. Step 2, select your ETFs, which we've already done for the most part, except for our sectors. Okay, so let's jump into sector world for a moment, and I'm going to bring up this chart. Again, from S&P Capital IQ, Sam Stovall wrote a great book on this. I think it's called The 7 Rules of Wall Street. Great book. Okay, he looked at this, and don't take our word, don't take my word, don't take S&P Capital IQ's word, but go do the research yourself, and you'll find something very, very, very interesting about what I'm about to share with you. But I need to identify what we're looking at. On the left-hand side, you see sectors. Those are S&P 500 sectors. Consumer discretionary, things that we don't really need that we just want, right? Flat screen, big 1,000-inch TVs or whatever it is, right? That's our discretionary products. Second down would be consumer staples. Those are the needs. We have to have toilet paper. We have to have toothpaste. We have to have those things, all right? Anything that you can buy at Walmart, consumer staple, okay? I'm kidding. Kind of. Then you go to energy, financials, healthcare, industrials. Industrials, the big equipment, right? The big, John Deere, Caterpillar, those big, the railroads, industrials. Information technology, that's just technology. Materials, basic materials. And then you go into utilities, flip your light on, run your house. And then the last column is the S&P 500. So that's what those sectors are. And then that second column, it says November through April, and it has average returns. And the data that you're seeing in front of you is from 1990 to April 2013. But I would say this, This goes back past 100 years. Same data. All right. It may differ by a point or two. You know, when I say point, you know, I'm talking 8.1 on financials, maybe actually 8.3 or 7.9. It's not going to vary too much from the numbers that you see because history repeats itself. And so if I'm looking at November through April, I'm saying to myself, there's 3 sectors that outperform other sectors. Now, if my goal is to outperform the market, I know the market's at 7%. Bottom column, 7%. In order to outperform the market, I need to overweight that which usually performs better. And that's consumer discretionary, industrials, materials. Okay, those are the sectors that typically outperform. Now, don't take my word for it. I want to share with you a couple things. Oh, and that is, even before that, I skipped a step. I apologize. Even before that, you need to go, and before you can look at charts or buy ticker symbols or implement this, you need to know what you would buy. And so in the same guidebook, you go through the same process, and excuse me for scrolling down, but you go through the same process. You say, okay, what ETFs am I going to buy? And here's your sector ETFs right here, a ways down. And you say, okay, here's consumer discretionary. Here's 2 tickers for my consideration. There's a lot more than that. And if I want to trade options, I'm focusing on whether it's optionable and whether it's liquid. And if I don't care about options, I'm just focusing on expense ratio. And so you need to go and you need to pick those ETFs that work best for you. I'm going to use everything with an X: XLY, XLP, XLF, XLI, XLV, XLK, and that's simply because most of them have liquid options. Okay, and so select your ETFs based on the same criteria that we brought up in the passive portfolio. And let me share with you something that's it's mind-boggling, because I know that all of you love charts. Okay, and so I'm going to bring up a chart of the XLY. This is consumer discretionary. Remember, this is the portion of the portfolio that usually performs the best November through April. Okay, and so I bring up XLY, consumer discretionary, and I'm going to just show you November through April. So, you know, April 30th, right? May 1st. I'm going to show you what the price action looked like. Your goal being to buy low, sell high. So you buy in November, you sell in May. Your return's about 4.2%. Okay, which it doesn't look great, but the market was down 11% in that same time frame. So did it outperform the market? Yes, it did. And then you go through and you say, okay, May I'm going to get out of it, right? May I sell, and then I come back to November, and let's see what happens in November. So I scroll to November. Look at this. You buy in November, you sell in May. You buy low, you sell high. You may or may not have this chart in front of you. It doesn't matter. You go off the calendar. You're up 34%. The market was up 18%, same time frame. You crushed the market. And then look what happens in May. Typically the market goes nowhere, and it did. It went, you know, this ETF went nowhere, and the market was actually flat during that time. And then you come in and you say, okay, I'm going to buy in November, sell in May. And you're up 17%. And the market was up 16% in that same time frame, so you outperformed the market again. And then May comes around, and of course we know that because we know by history that these things happen. And then in November you buy and you sell in May or the very end of April, and you're up 21%. And during that same time frame, the market, the S&P 500 again was up 16, so you outperform the market again. And then we go sideways to up a little bit in May through November, and then November through April, You buy low, you sell high. And the market in that time frame was up 13%. Same time frame. You're up 19. You're outperforming the market. Think about that. You're buying low, you're selling high, and you're not even looking at a chart and trying to time the markets. It's pretty incredible how history truly does repeat itself. Okay, and then let's look at materials. I'll bring up a materials ETF, and let's just kind of look at the same thing. XLB, and I bring up XLB, and I did the same thing. It's flat, down 0.9%. The market, that same time frame, was down 11%. So you're outperforming the market. And then it goes buy low, sell high. You're up 21%. Okay? You outperform the market by 3%. But here's the thing that's going to throw you. I think you're getting the picture from a historical look. But here's the thing that's going to completely throw you, is when you say, okay, I'm going to use history to help guide my portfolio. And then something like this happens where it goes from 32 down to 27. And you're going to look at that and you're going to say, this stupid historical stuff isn't working. Because my ETF is down 10% in a month. And you're going to sell. And you're going to sell at the worst time. And why am I saying this? Because I've been there. You got to hold tight and you got to say, these are historical returns. I'm not going to get carried away. I'm going to hold tight. And then you're up 21% in that time frame. Okay? You've got to be aware of your own psychology. And then, buy low, sell high, right there. Buy low, sell high. What did the market do that same time frame? It was up 16%. Okay? So you're seeing it right in front of you. It goes down. Oh, buy low, sell high. That's fun, right? Buy low, sell high. That's fun. Okay? And so you're using this history to help guide your portfolio. And so in November through April, you're what we call overweight those certain sectors. And then May rolls around, and you've heard the phrase, sell in May, go away. Well, I say no, sell in May and reallocate, because guess what? There's certain sectors in May through October that outperform better than others, and that's consumer staples and healthcare. Those perform the best. Okay? So if I'm looking at the same thing, let me show you visual representation. Consumer staples, that time frame. Buy low, sell high. Let me look at my my historical market information. The market during this time frame was up 19%. You're up 20%. Okay, I've got another piece of paper on me showing me the market returns for the same period. And then you go, what is that? May through November. You're up 6%. Buy low, sell high. Okay, you're not timing the very bottom, sorry, but you're up 6%. Market was up 0.7%. Okay, you're down during this time frame, May through November. You're down minus almost 2%. Well, market was down 7%, 7.5%. So you're outperforming the market. And this is it. 5.2%, buy low, sell high. Okay, buy low, sell high. Market was up about 3% that same time frame. So you're outperforming the market simply by understanding market history. That's it. That's it. That's your super active approach. And so what you need to do is you need to overweight what's in favor, you need to underweight what's out of favor, and you need to equal weight what remains steady. And so this is how I approach it. Here's my table. Okay? Let me go to the Word doc. Again, we're $60,000, and I'll take us to that Word doc so we can kind of crunch some numbers. And if I do this, I say, okay, I'm going to own the SPDR. Remember, this product is the S&P 500. It already owns every sector. It has exposure to consumer staples, technology, discretionary spending, basic materials, industrials. It has exposure to everything. Okay? But what I'm going to do is I'm going to sell a little bit of my S&P 500 position, and I'm just going to buy a little bit of discretionary, consumer discretionary, XLY ETF, and a little bit of XLB, which is my basic materials. In fact, I'm going to sell 10% of my S&P 500 position. I'm going to buy 5% and 5%. So my new numbers shake out to be this. I'm going to own $31,500 of the S&P. I'm going to buy $1,750 of the XLY and XLB. That's how I'm going to approach it. Let me grab the calculator. Now, why didn't I put a couple questions? And so I'm recalling some of the questions that I usually get when I do a presentation like this live. The question always comes out, well, why wouldn't you just ditch all your SPY position, your S&P 500, and just allocate to the top 3 performing ETFs? And you could do that. There's what we call benchmark risk if you do. And benchmark risk is simply this. What if XLB decides not to perform that 1 6-month period? XLY still does what it does, but XLB does not. And so you lag the market because you have no exposure to those other sectors. That's called benchmark risk. When you allocate too much to one sector and that sector underperforms, it's going to perform because probabilities tell us it's going to perform, 7 out of 10 times, 8 out of 10 times. But what if it's one of those 2 or 3 times it doesn't? That's what opens you up to risk. And so personally, I look at the SPY and I say I'm still gonna own it, but I'm just gonna buy a little bit more XLY and XLB, and that's what creates the overweight status that I mentioned. Okay, that overweight. And so let's do this. Let me just crunch the numbers real quick. I'll say 3,100, or not 3,100, 31,500 divided by $170. If that was the SPY, I'm buying 185 shares. And then I look at that and I say, okay, how much of the XLY am I buying? Well, the XLY, 1,750 divided by 60 bucks, because that's where it's trading, and I'm going to round up to say 30. And then what else is there? There's the XLB, and the XLB, 1,750 divided by 42 equals 4, let's say 42. That's how many shares I'm going to buy. Now, you go into your brokerage account and you just sell a little bit of the SPY and buy those. And that's it. That's it. And so from the standpoint of a super active portfolio, it's important to note a couple other things. And that is, let me go back one slide. In May, so on May 1st or April 29th, whenever, give or take a few days, you shift your portfolio and you sell these products, XLY and XLB, and you overweight the XLP and XLD, which would be healthcare, staples and healthcare. I keep saying the ETFs, figuring that you know what those ETF symbols mean, and I apologize for that. Consumer staples, XLP, XLV is healthcare. So you overweight to those based on the time of year that you're dealing with. All right. So how do we move forward and how do we manage it? Well, I just mentioned it. Semi-annually, you flip from what I'll call those I call them offensive sectors, which is your consumer discretionary, your basic materials, your industrials. You shift from overweight that to overweight your more defensive sectors, which is staples, healthcare, those things. And that's what you do. So you rebalance twice a year, and you sell covered calls if you so choose. One thing, that's how you manage your portfolio. Now, a couple things that I want to point out here. Questions that I received as we were talking about this and as I present this to other people, and that is simply the case of stop losses. Everybody always asks me, well, do you use stop losses? And my response is no, I don't, because I utilize something else. Now here's the thing. I'm going to go to a 10-year weekly chart. And in fact, let's go to a 5-year weekly chart. I'm going to bring up, let's bring up the SPY, and I'm going to hide all my drawings. Let me hide drawings, drawn items. Okay, so there's my S&P 500. Now what, in lieu of stop losses, number one, I'm a young individual. I consider myself young. Don't ask my kids. I'm 36 years old. I've got plenty of time ahead of me to where I don't even need, I'm just going to ride out the market. If it starts cranking downward like it did in 2009, I'm going to ride it out. I'm going to use options. I love options. I'm going to use options, but I'm going to ride it out. Why? Because I have time. Now, if you're on the cusp of retirement or you're in retirement, you can't withstand a drawdown. Let me go back to that thing. You can't withstand a drawdown because you've got to preserve capital. And so what I have on this chart is a 10 period, and I'm not going to get into technical analysis a ton, and if you want more information, I'll tell you where you can find it in a moment. This is a 10-period exponential moving average. This is a 40-period simple moving average. And all this does, it's a crossover method. So when the green, which is the shorter term, the 10, crosses below the 40, you get out. You're bearish. You get out. Okay? And when the 10, at that point, when the 10 goes back above the 40, you get back in. I'd also say this. Some people like to put a time filter on that. What I mean by time filter is they don't get out the moment it crosses, but they wait a few weeks. And let me share an example. This is back in 2007. Here's your 10, crosses below the 40. Okay? I typically, would look to wait 1, 2, up to 3 weeks. Let's go 3 weeks. You have a 3-week time filter, which means that each one of those candles represents a week. I wait 1, 2, 3 weeks. I get out. I'm bearish. I need to preserve capital. I get out. And I don't get back in until the green crosses back above the red, the 10 above the 40. And so I get out and boom, you're going from, call it 120 bucks all the way down to at one point 60. Fine. You have 50% drawdown. But we're out, especially if you need to preserve that capital again. So when do you get back in? You miss a good bounce, but you're getting back in right around, 85. And you get in when the 10 crosses above the 40, and you wait a couple weeks, and that's your stop loss. That's in lieu of your stop loss, is this crossover system. Okay, and you can take it through here. You get, a little bit of, and it may what we call whipsaw you a little bit, but typically, let's look at the last crossover that we had right here. You're catching the major trends. This is a trend following. You're catching the major trends, and you're riding them. You're getting out here, and that's okay, 10 below the 40. 1, 2, 3, so you're getting out in here, and then it goes back up. So you're back in, and you ride these trends. So it gets you out during volatile times and in bearish times, but it gets you in, and you will ride the bulk of, not all of, like I would if I stayed in the market at all times, but for those that want to preserve capital, you're riding the bulk of the market up, and you're getting out when it's starting to head down. It's just a timing system. And so that's, from a stop loss perspective, that's what I would do instead of an actual stop loss. Now, if you want to put stop losses on stocks, great. If you want to, buy a good stock at a good price, that offers a good dividend and then put a 25% trailing stop on it or a 20% trailing stop on it and just let it go, great. But for the ETF strategy, if you want to get out of the market, then that's the approach that you would follow. All right. So today's goals, we identified a model portfolio. We built a passive portfolio. We looked at market history. We build an active portfolio, and we build a super active portfolio. And now you you're jumping cliffs. Don't really know what that picture represents here, but you're victorious. You're jumping a huge gap in a rock. So there's today's goal. That's what we accomplished. Again, thanks for tuning in. I want to do one other thing real quick, and again, I mentioned it earlier, and that is a couple things, actually, as I round out. Let me go back to that PowerPoint. I apologize. It's important for you to understand that this is the bulk of your portfolio. If you don't want to do this, which I think you can absolutely do it and do a good job at it, then find somebody that can. Okay? It's simple as that. I spent a lot of time with investment advisors, and there's some good ones. There's some bad ones, but certainly there are some good ones. And so, as a consideration, if you don't want to do it yourself, find somebody that believes in the same methodology and do it. And listening today, now it's time for you to relax, go find a nice chair somewhere on a beach, manage your portfolio the right way, and use history as a means to help you manage that portfolio. Thanks, everybody. Appreciate it. Question? Let me know. And here's your final disclosures. Take care. See ya.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and/or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.